is the whole concept that you could do the exact right thing and lose money, and you could do the exact wrong thing and make a bunch of money. I always make the joke that I could come into the office and I could smash my forehead on the keyboard and make 10 grand. It doesn't mean it's a smart thing to do. It's
Ever wonder what truly connects traders from Tokyo to London to New York? It's not English, it's not Mandarin, it's the charts. There is only one language that connects every trader on every desk in every time zone. It's the visual language of fear, greed, and all I definitely should have set at stop loss. It's technical analysis is the only universal language of the markets. Understand its signals and you understand the world. Join me, Flávio Lemos, on Traders of the World as we decode the global conversation. Stop guessing, start understanding. Hello, welcome back to Traders of the World, the only show fluent in the native tongue of the market. Before we dive in, a quick note for our audience. If you get any value from this conversation, please do us a big favor, hit that like button, subscribe, and leave a comment below with your biggest takeaway from today's very special interview. I'm so excited because I'm not alone. I am joined today by my friend and incredible co-host, Haroldo McDowell, a portfolio manager and risk manager with 30 years plus years of experience across futures, options, forex, exchange, and equities in the US and Latin America. Built and led a 12-trader desk in New York and in Rio. Oversaw clean execution for complex futures and options traders. And established a multi-FX dealer clearing relationships. Founded an operation since 1998 at Norley Master Financial, with a consistent focus on discretionary and systematic trading. That's why he is here today. His controls and client advisor. Master in Economics, MBA, NSD Series 3 and 7, CMT member, advanced training in GAN and Elliott, and derivatives. Hello, Haroldo. How are you doing?
Nice to meet you guys. Nice to meet you. It's an honor to be here with you guys.
Okay, let's be honest. Trading is hard. Not because the math is impossible, but because we are impossible. We hold losers too long because pain hurts. We chase winners because fear of missing out is real. We revenge the trade because, well, we have egos. Our guest today says there is a cure for this human condition. It's not therapy, it's systematic trading. He is Michael Nauss. He started trading firm Money in 2006 while still in university. He is working for hedge funds, property firms, and tech companies. He holds both the CMT and the CAIA designation, and he is the CEO of Status Edge Trading. His philosophy is simple. Stop trying to be a hero and start following the data. He uses plus 25 years of backtested data to trade calmly, bull markets, traveling through bull markets, bear markets, and everything in between. Michael, welcome to the show. Let's talk about how to stop our brains from losing our money.
That was an awesome introduction. Thanks for having me, and it's great being here. That was great.
So here's the plan. Grab your coffee, make it a double, and focus right after the intro. Don't go anywhere.
You ever wondered what truly connects traders from Tokyo to London to New York? You just need to learn the language. That language is technical analysis. Understand its signals, and you'll understand the world. Welcome to Traders of the World. Here we skip the jargon and just figure it out together.
Haroldo, shoot you off.
Okay, all right, Michael. You started a trading firm, I think it was 2006, right? And while you were studying math and finance, I believe so. So that's quite a a head start. And how did that early experience shape your belief in that discretionary trading, and just going you're just going with your guts, or you eventually going to fail you, or was eventually how did everything started?
Yeah, it was interesting because it wasn't kind of what I thought, So I was going to my undergrad in finance. I thought it'd be like an investment advisor or something like that. And then there was just a job fair that opened up, and there was just a booth for a prop firm. And I got an interview there, and I went and I started talking with them, and I expected to, we asked me about like the CAPM model and all this stuff that I was learning in finance. And they were asking me about like what video games I played and things like that, because this was before the market got incredibly computerized. So we were almost the original HFT markets, right? Where we were, I was placing hundreds of trades a day in and out, sometimes in seconds, and trying to, make the spread and do a lot of these things that I'd almost consider games more than trading than anything. And yeah, it was a huge contrast to, learning something in university about, even back then, hopefully it's a little better now, but the charts were tea leaves and voodoo, and no one could manipulate the market. And they had all these things that they said, and then you would go to the actual trading floor and see the complete opposite, right? See a guy making a whole bunch of money using charts and seeing, showing manipulated markets and all of this thing. So it was a huge eye-opening experience, just the difference between, which I think is probably the same in a lot of industries, where it's, the academic world and then the real world. And there was,
completely different animals. Exactly.
Yeah, huge conflict there. Yeah.
Completely different animals. That's true. That's true. Flávio.
Okay. You have written about the real reason most traders lose. Spoiler alert. It's not the market. It's the trader. You list biases like loss aversion, fear of missing out, and revenge trading as the enemies. Which one of these was your personal nemesis before you went fully systematic?
Oh, definitely revenge trading. I was that guy. I was the guy who, you would buy a stock at 10 and you'd put a stop out at 9, and it would hit 9, and then it looks like it's bouncing, and it's like at 9:10 or something, you just buy right back in, and it's just immediately trying to reclaim that feeling of, oh no, they came and got me, and now they're gonna. So just revenge trading all the time, to the point where at the prop firms I had them like hard code in rules that you couldn't place another trade within a certain period of time of your last trade, to try to like force a cool off period, because that was me. And it's funny because I think all these come from the same emotional base, which is just the pain of, you lose money, and that hurts, and you're just trying desperately. So I think it's the same with people who move their stops so they don't get stopped out, or revenge trade that's the name right after, or whatever it is. I think it all comes from the same root. But yeah, I was a huge revenge trader for sure.
You say you are not a robot, but your system can be. How does a systematic approach actually fix something like recency bias or revenge trade, where we let our last 5 trades dictate our next one?
Yeah, well, I think the main advantage is, there's a couple, but the main one I always find is I have something to compare myself to. I think part of the problem with trading and investing in general is the whole concept that you could do the exact right thing and lose money, and you could do the exact wrong thing and make a bunch of money. I always make the joke that I could come into the office and I could smash my forehead on the keyboard and make 10 grand. It doesn't mean it's a smart thing to do. It's because we're dealing with a certain amount of randomness. So you could do everything totally wrong and make a whole bunch of money. And I have now something to compare myself to. I have the back tests and the systems that I run, which at the end of every week I go through and I run. I say, this is what the system said you should have done, and you can always go back to that. And I use that as my benchmark now. I don't care what the markets do, as long as if the system said I should have done these 5 things and I did those 5 things or better, then great. And if I did worse, then I have to go reevaluate. So that's the main benefit that I think a lot of people don't talk about with systematic trading, is just that you have that benchmark, you have that thing to hold yourself to understand if it's you or if it's your system. A lot of people don't even have that connection where, there's a lot of people, we're in a bull market in the US, and a lot of people are making a lot of money, and they don't know whether it's them and their system and their style that's making the money, or if it's the market doing well. So I have a third benchmark that I think is really, really important to hold myself to.
That's very important. I think this is the way to lead, for suitors. But getting into that subject, let's get technical. So you have a presentation on redefining relative strengths, right? Mm-hmm. So you mentioned that the primary goal is outperformance, but look at it differently. So can you share your screen and show us a little bit how to use it, and a position range or RSI, or identify true strengths versus just a stock that's going up or something like this?
Yeah, I just brought some back tests with it as well. And
wow, that's nice.
I think because these are more or less how I look at the market, even more so than the charts. Like my charts are usually very clean, so I need to look at the market. But I run a couple models, and what they're doing is they're trying to rank securities by relative strength, but not necessarily using the classical version of relative strength, which for the listeners, right, is usually just dividing one asset by the other. And if the line's going up, then it's relatively strong. But looking for inefficiencies and looking for places where people aren't, I find that if you can rank them sometimes by different indicator values, you can end up getting some really decent outperformance. So for example, one system I have that I can just pull in here is very simply looking at stocks that are, there's more to it than this, but stocks that are doing more dollar volume than everything else with an average rate ranking. And right now you could almost imagine what those particular stocks are, right? And that's this red line right here, right? It's, smooth to the upside, the gray shaded area is the combination of all the strategies. But there's some relative outperformance simply by saying, show me the stuff that is doing the most dollar volume, which is just volume times price, has the most money flowing through it is probably the best way to do it. And with some very basic caveats, like being above long-term moving averages and things like that, let me just every month rotate into the basket of the top 10 names that people care the most about. And that might not be relative strength in the normal technical premise that a lot of people look at it. But if the most amount of money is flowing through them and they're above some short-term moving averages, which is a proxy for trend, there's probably something. And again, we could all think of the names that this strategy is in right now. It's in your Nvidias and your Microsofts and your, the AI type of play. And it's not because it knows anything about AI. It's just that's where the money's flowing into and out.
Right, exactly. Inflow. Money is like inflow and outflow. That's
you put the same weight on every component.
On every company, yeah. So
you are combining all the factors, but with the same weight.
Yeah. So I guess this is explain what we're looking at. So the light blue line's the S&P 500. The green, yellow, and red lines are three different strategies, which are all investment strategies that update once a month, and they're all ranking stocks by different metrics, right? So
not
yellow
the same position at all.
Right, and the idea is that you split your portfolio out, and you combine those. That's really, if there's like one, holy grail or one thing that I think is so important for trading is multiple strategies, right? So then the gray shape,
100%. Yeah,
it's the combining those. So yeah, for example, the red line is saying just give me the stuff with the most amount of dollars that went through it. And then the yellow line, again, with these are all some caveats and there's some secret sauce and all that in them. But essentially saying, show me the names that the RSI has been not oversold for the longest and go out. And, these are names like Eli Lilly and some of these names as well. And you take those two and they're both good strategies in and of themselves. Then you combine them, you get a really good strategy. And then you combine that with the green line, which is just a momentum investing system. Show me stuff that's breaking to new 52 weeks highs, and I'll buy that. And again, combining those three strategies, you end up getting this kind of relative outperformance. So to go back to the question about kind of measuring relative strength, I think you find a couple different ways to do it, and it doesn't have to be complicated. It's a couple different ways that maybe people aren't thinking about what relative strength is, and you take those and you combine them together, and you diversify your portfolio across that. Where if the ones that have the most dollar volume start to fail, well, I have two other strategies that will hopefully make up while that rotation happens. Because if you go back and look at that particular most money flowing through strategy, you go back to pre 2008, it's a lot of banks, right? And then in the middle, it's a lot of more boring kind of tech stocks, and now it's the AI trade. And then a couple of years from now, I'm sure it'll be something completely different.
Something else,
but need to, right?
But do you combine them equally? Let's say for $100,000, you put like 33% in each one of them, or you just put different weights in each of them?
Yeah, I put them equally. I think reweighting strategies is something where people could use traditional chart analysis and maybe some discretion on. So these are investment strategies, but I also brought these ones in particular, which are more, call them swing trading ideas for a week or two. And it's momentum, mean reversion, and kind of pullback. I could definitely see a world, I do a little bit of this, but not too much. I could definitely see a world where you're doing a lot of say you're someone who's really good at breadth analysis or something like that. And you're seeing breadth weaken a bit, and you may say something to the effect of, okay, now that breadth is weakening a bit, I want to be more interested in mean reversion strategies. I think the market's going to enter a choppy time. Maybe momentum isn't going to be a factor that's doing the best. And I could definitely see a world where you probably continue to trade all three, but you just weight them slightly differently,
slightly different. I got you.
I'm going to lean more on this strategy and a little bit less on this strategy. I could see that could be a place that a human could add a little bit of maybe alpha to these particular strategies.
Okay, gotcha.
Talking about this at your firm, StatsEdge, you break down your systems in swing, day trading, and investing to fit different lifestyles. For instance, the day trade system, you mentioned three types: pullback, mean reverse, and momentum. How do you determine which regime the market is in to know which system to deploy? Can you show us an example, please?
Personally, so I deploy all systems at all times. I may just weight them a little differently, and I employ the day trading, the swing trading, and the investing all at the same time as well, because I just don't really know too much better. But again, I may weight a little bit more. But I think there's two metrics on whether or not you want to be a little bit more short-term and long-term in nature. And one could just simply be the volatility of the market. And you could measure that pretty simply, I think, just with an ATR, like a standard ATR indicator, and just say, okay, this is one of the things I like to do is, how wide is the average range of the average candle. If you're in a period like this, where you can see the bands are very small and the market's not moving very much intraday, this is a really good environment for swing trading and investing, because you get the slow grind higher.
Slow grind, exactly.
If you're buying something, you can let it work for a period of time, and then you enter periods like this where you don't even need the indicator here. I think you can just eyeball it. Things are getting a lot more volatile. Price isn't really moving anywhere. This is a time where a lot of the day trading strategies I find shine much brighter, because it helps me sleep a little bit too at night, knowing that I'm more in cash than I would be. And then within those, there's, like we talked about, my mean reverting strategies are doing way better. Trying to buy momentum or trying to buy breakout in this market is just not doing well. If I was confident myself to know that this type of action was going to continue for some period of time, I could see really sizing down. You're taking the momentum alerts maybe with half the size, and then you're taking the mean reversion strategies with like a 1.5 times size, because you could just see with this market, buying dips has been phenomenal. So the question is, are you good enough to kind of predict that what environment or what sandbox that you're kind of playing in for a period of time?
Exactly. That's very interesting. Your work is very interesting. But talking about, we've been throughout micro shocks, pandemics, war, rate scales, do you have a couple charts showing this specific sectors? How do they react in those events, and maybe interest rates or Ukraine war? Example, how does the systematic relative strain approach on that time that the market is in this kind of how to say special events,
Yeah.
Macro shocks.
macro shocks. Yeah.
And yeah, we're seeing more and more. I'm only 40, so I don't think I'm that old, and I've heard more. This is a once in 100-year event. I think more time than the last like 5 years that I've heard. I've heard anywhere, and this is, I think, a huge power of systematic trading. Is I very intentionally run all my back tests from the year 2000 because I want to see the worst of the worst for kind of our generation, which dot-com bubble, great financial collapse, COVID, the 2022, 2023 one. And the most important part to me is not really that the returns are the best thing in the world. Is I'm looking at this equity curve very, very closely during those periods of time, because anybody can make money in a bull market, right? I always say, this year, if you're not doing well, you really have to reevaluate what you're doing, because, ever since the tariff tantrum, it's been a pretty good bull market. I'm looking at these very closely. And I'm saying, okay, what happened in the year 2000? And I don't have it right here. I can grab it real quick, but I have a drawdown chart too. And I'm looking for those drawdowns in that particular period of time, and just seeing what was the drawdown for these particular markets. Because I think that is going to be more important than anything. Like, we started talking about psychology, and this psychology is going to be very important, because if you can't stick with your system during these drawdown periods, it doesn't matter what it does in the good periods of time. You're going to do what a lot of traders do, and a lot of traders struggle with, which is system hopping. Then you have something and it works well for a period of time and it's great, you're making money, and then the drawdown comes and you completely abandon what you do, and then you go on to the next thing. And probably at the worst time, probably the second you've landed on a new system, that first system would have started to make its way out of drawdown. So this particular chart is just a drawdown chart of the investment strategies that I showed, and it just shows where the worst drawdowns come. And what I want to see is low to no correlation with the worst drawdowns of the market, which is the kind of blue shaded area. So the green shaded area is the combined drawdowns. And you can see here in 2022, 2023, they both entered drawdowns, but the system was able to do half. So this is where I think a lot of the focus has to be when you're talking about these macro shocks. Is we've seen a lot of them in the last 20 years, right? We've seen great financial collapses and war and pandemics and all of that. And you want to go in, you want to say, how is my system, how has my trading been able to adapt? Because we don't know what the next one will be. And each one, there seems to be a different defensive asset that pops up. The classic example being 2022, 2023 bear market was one of the worst for the 60-40 portfolio. And that's supposed to be the safe portfolio that saves us from everything. And it wasn't for what was almost a pretty benign bear market of 25% max drawdown. We were in drawdown for maybe 2 years. It wasn't a crazy bear market, but because the interest rates were hiking at the same time that the equity market was going down, it weakened. So I think it's very important from a systematic point of view to say, can my system adapt not just to a bear market, but to multiple bear markets? Because we don't know what the next one will be, and it could be that the system falls apart during that. We don't know the future, but the fact that your systems, if it can hold on through different bear markets that happen for different particular reasons, then I think you're on to something more than it survived the last one. Okay, right? That's part of the problems.
Michael, it's time for the question we ask every trader that comes here. We want the glory and the pain. What was your best call, best trade ever, where the system worked perfectly and you felt like a genius? And conversely, what was your worst trade, the one where maybe you overrode the system, or the system just got it wrong and it humbled you? the one that delivered the most painful and probably the most valuable lesson of your career? If you are really, we'd like to see the charts of both.
Sure. So I would say a lot of the best trades, I've been, and I'll just pick recent examples so people can know, is I've been in Nvidia most of the year, and it was the dollar strategy, right? From a lot of kind of down here in about the 50s or so, and still sitting on some of the position. And that was because this was the thing that was pulling through the best. And thankfully, I've had the ability to stick with it, right? One, and I know this is going to be just a little in the middle, where this was a great trade, but I feel it's one of my biggest regrets was, no, it wasn't this. It was AFL. No.
A Trader Brasil comemora 25 anos e quem ganha é você. Fomos eleitos por 2 vezes pela Rank Awards em 2024 e 2025 como o melhor divulgador financeiro e a melhor academia de formação de investidores do Brasil. E hoje temos um presente para os inscritos do canal. 10% de desconto em nossos cursos usando o QR Code que está na tela. E não se esqueça, é muito importante que você nos siga nas redes sociais. Curta, comente e compartilhe.
ELF. There we go. Yeah, this one. So this was another just simple momentum breakout on this beauty supply company. And this stock went from $32 to nearly $300. It was like $250 or something at the high. And the reason that this one's painful for me is because I overwrote the system and got out for maybe like a 20 or 30% gain. And, the thing just ripped from there. And then probably one of the worst trades I ever did was we'll do, I guess, like a Peloton. This was kind of a part of the same momentum strategy. And this one was one where this gap right here should have, in theory, been an exit point. So we bought, it was a pure, break new highs. And these, I think, are the ones that get you in the most trouble, where you almost get addicted to doing so well on the stock that it's rewarded you for so long. And I believe this was an earnings report. And in one earnings report, Peloton gap down here, it's like 35-40%.
Wow.
And the strategy should have said, hey, it's gapped well past your stop loss. You should exit it completely off the open and just move on. But, I did the thing that we all do where we go, I'm going to leave it for a couple days and maybe it'll fill some of that gap. And when it fills some of that gap, I'll get out for a little bit less of a loss. And then you can kind of see what happened after that. It just fell another. And by the time I exited, I think I should have taken roughly a break even after being, and this is, I think, what really got me, is that I was up so much on it, and when it gapped down, it was roughly a break even trade, and I think I took like a 30-40% loss on that position by the time I actually just said enough. And I use this as a lot. I try to remind myself of this a lot, especially in really good markets like this, that at some point they're going to come to an end, and it almost feels like you're like killing a friend at that point, because you're looking at your account every day and you're seeing the amount of money you're up on this position. You're like, this is amazing. And looking back, it's they sell a bicycle with an iPad strapped to it. It's like, it doesn't make
everybody come against the dream.
Yeah, it's just it doesn't, I don't even like the company at all, but it didn't make any sense. But I think that was the biggest part, is I generally never get into trouble when I buy something and it turns into a loss immediately. That's never where I have any kind of emotional problems, because I understand my systems. They're going to be right 55-60% of the time, if that. So I know, almost half of every trade is going to lose money. I think what I have problems with is when, the thing was up a lot and now it's coming back. I think that almost hurts me more. Say you're up 30% on a trade, and by the time you exit, even if it's a positive trade, you're up like 5% on the trade, that still almost feels like a loss. And it reminds me of, there's a very famous psychological experiment that's been repeated 1,000 times, where if you give someone $20 and you get them to score how happy they are, and then you take the $20 away from them, and then you get them to score how happy they are more mad than when they started, even though financially they're the exact same position. So that to me is I find when I do the dumber stuff is when it was working really well and then it's come back and it's turned into a break-even trade or a loss or something like that. For me, that's just a little bit more triggering.
The market want the money back.
Yes. Yeah. And, you get the whole, I could have just, right, with Peloton, I could have just sold. It would have been, like 100% gainer. That's like a once in a couple year gainer that you get something great like that. And now it's break even. So that's, I think, what triggered me to say, I'll give it a little bit and then right down.
I used to say that, I just lend a little bit to the market. Let me get it back with interest.
Yeah, exactly. Yeah.
But talking about that, what would you say for people that are struggling, that are starting? What would be your advice, actually, for novice, trades and as well? Where can we find, this masterclass in discipline? Where is your audience? Where is your work? How can these people find you? And things that you write. It's a big question, but anyway.
Sure, yeah. And I'm Michael Nauss, CMT everywhere. There's no Stats Edge Trading is the name of my business, but
what's the name?
Twitter. Sorry, Stats Edge Trading is the business. But if you Google Michael Nauss CMT, TikTok and Substack and all of that kind of stuff, it's all there. But for newer traders, I would say start with a system. Even if you want to be a discretionary trader, develop even the most basic system of, I'm only going to buy stocks above the 200-day moving average or whatever it is, the most basic system you can, because then, like we talked about, you have that benchmark. And we are in a different world where I'm not a coder. A lot of the pure systematic work that I've been doing has been coming along more and more with AI and LLMs, is that they make up for what I lacked, which was the ability to kind of code and really go deep into these backtests. So start with just the most basic system in the world and kind of start branching from there, because even something as simple as like moving average crossovers, which is like I think the first page of the CMT textbook, those things can work in the right environments and in the right stocks, and then you're taking a lot of the emotion out of it, right? You notice that generally speaking, people will have their most emotional problems when they're in a trade. Because they haven't systematized the exit. So even if and I think a lot of people don't go to systematic trading because they want to be the one to pick the stock that does very well. I think that's absolutely fine if you want to do that, but systematize the exit parameters so that you know exactly the things that are required to get you out, like MACD cross or an ATR trailing stop or whatever it is. Because I always say you are the dumbest you will ever be when you are sitting on either a large gain or a large loss. You can be very intelligent and objective when it looks to picking a stock or getting into a trade, but when you're getting out, the emotions are flying and everything is bad. So we're in a world where you could buy a stock and you could have a bot just say, hey, I exit it when this occurs, and then walk away. And I think most people, as long as you systematize the exit, even if it's a very basic exit, will be way better than the average trader out there who just doesn't know when to sell. And I think that's really important for this particular market that's been a crazy bull market for most of the year. And yep. When it ends, I don't know if it's tomorrow or 5 years from now, the ones that can stay in the game and play the next bull market whenever it comes are the ones that had an exit plan and they were able to raise a bunch of cash when the time's appropriate and not be on margin. So, start with systems and more importantly, start with some type of exit system. And I think you're just way better off there than most.
Awesome.
Michael, do you recommend any books on systematic trading?
Yeah, there's anything by Van Tharp is going to be great. He's a pretty legendary systematic trader. I think a lot of it I'm a really huge fan of Substack now. I don't, I have a Twitter and I do a YouTube and all of this. I really, really like a lot of the writings that other systematic traders are doing on Substack. I don't know if it's like their algorithm or what they do to work, but I just find like there's a whole group of nerds out there that are sharing their ideas and even some snippets of code and things like that. So there's a lot of books. Anything by Van Tharp, take a look at. But yeah, I really, really like Substack and what they're doing, because it's just creating a little community. And I don't know if it's by algo. If you go on Substack, maybe it's something different. But yeah, just a great community of like-minded traders that are sharing a lot when it comes to their systematic journey. And like anything in trading, it's going to be different for everyone. So yeah, check them out. Yeah.
Okay. Michael, thank you very much. Your approach is a refresh reminder that while we can't control the market, we can control our process.
Exactly.
Thank you for sharing your shots and your wisdom. Thank you very much. Thank you, also Haroldo.
Thank you, Michael. Thank you, Flávio. That was very nice to be with you guys and with you, Michael, especially. Thank you very much.
Thanks for having me, guys.
Okay. That's all we have for today on Traders of the World. A big thank you again to Michael Nauss of Stats Edge Trading and my friend Haroldo McDowell. Until next time, stop revenge trading, trust your data, and let the system do the work. Take care. Bye-bye.